Hi, I'm Keith McCullough, and welcome back. We're going for the third conversation, one of the most important conversations I've had in Hedgeye history. That goes back 17 plus years now, was the initial conversation I had to preview the year with the one and only Mike Taylor. Now, well, first of all, welcome. Thank you for coming back.
Thank you.
The man.
Thank you for having me.
Now, I don't know, like first of all, I thought like people putting out predictions was like an old wall thing, like, you know,
Passé.
Barton Biggs, you know, like stuff of our former life. But he did. He posted on Twitter. He had his 2025 predictions. Like, look at some of these, just to highlight like the top three. Recession talk will begin in March. Check. Tech has a gigantic correction. Check. All the way down at the bottom, never mind our Moderna short working out wonderfully, and Novo too, but Tesla gets cut in half. Check, check, check. Now, and I think you added that one, the Tesla one, after our discussion.
Well, I figured
you also had Walmart misses. I mean, you got like a whole bunch of things. This is really hard to do.
I enjoyed the amount of money I made.
Good.
But it is hard to do, but let's just say it wasn't that hard to do. It just made a heck of a lot of sense.
Yeah.
And that's why I put it out. Just like in, was it 22, after the COVID, I was like, nobody can hit these margins, short everything. These margins are fantastical. And then we had a huge tech correction. That was actually easier than this. This was quite a bit harder, because in this instance, we're going to miss on revs and margins. And that's very different than that. And it really had to do, and when we talked about it last time in January, I was like, well, it's really going to be the government comps on spend are impossible to comp. And we're going to have a 1.5% drag on GDP at a time that we're already going into a recession. And it looks like that's going to be true. I thought that this tariff thing was going to be a medium-sized road bump. I did not know, I did not know until, and I thought many did not know that this was going to happen. And it looks like, as of right now, as of like literally this hour, we're going to go to the mat with China. And it is going to be extremely painful.
Can you get into that, you know, whether or not, and I see people like mincing over, well, it's this calculation, it's really that percentage tariff or this or that. To me, it's just more about getting the direction right.
Yeah, but as you remember, most people can't short or don't short.
Right.
99.9% of the world is just long.
Yeah.
And we're in what you coined the mother of all bubbles. We're there. This is the mother of all bubbles. And I'm sure you've talked to many managers. I've talked to at least 50 money managers this weekend, just nonstop. My kids were mad. My wife was mad. You know, I'll give you an example. Around 6:30 a.m. on Monday morning or Sunday morning, I can't remember because they all blend together. I got a call, and it's a big broker, multi-billion-dollar portfolio, blah, blah, blah. And he goes, Mike, you got to tell me, am I okay? Am I set up right? And he starts articulating, you know who you are, and I apologize, I didn't tell you the rest of the story that I really didn't have the heart to tell you. I'll tell you now, not naming names. He's like, I'm a third in stocks. And I'm like, God, that's light. That's good, check. I'm a third in treasuries. Okay, check. And I'm thinking, is it gold? Is it? No. And then I'm a third in this really great high yielding corporate debt products that have yielded 8 to 9%. But their security says, so we're good. And I think that we're going to run into a moment in the not too distant future where we have a huge problem with that.
Well, I mean, they're explicitly linked to the rate of change of revenue and cash flow growth. You know, when people classically look at or measure and map credit risk, that's what you'd be looking at. You'd be looking at, okay, I see revenues falling or cash flows falling. I mean, let's just use Tesla. I mean, Van Sciver just did a big presentation on them not generating an operating profit. I mean, you know, these are credit events with stocks too. I mean, there's stocks in that case that's tied to the credit event.
Yes.
Just walk through that. I mean, just walk through how that played out. You got this right in 2008. That's how we met.
Yes.
How the credit comes back to the bubble in equities.
What's different now versus other times is private equity. Private equity is gigantic, and it is in, whether you know it or not, it's in these people's retirement portfolios. And it was not like that in 07, 08. They were more liquid. Sure, we had levered up mortgage situations in pension funds, things like that. But now we've gotten out of that into illiquid things, BlackRock, Blackstone, all these guys that have made these credit products that have found our way into accounts. And it looks great because it's secured, it's 8% yield, and it keeps coming back for more all the time. But what they don't say is the leverage that's associated with the underlying business. Many thousands of private equity businesses have been lever up, buy an asset, and it runs at a single-digit margin. And that's really been the name of the game. And I think we're going to walk into a period in the very, very near term, 2Q, that this is going to start to unwind. And then we're going to find out who has no clothes when the tide goes out. But we're in the moment right now where the tide is going out, whether we have a deal or we don't have a deal on tariffs.
Well, I was walking through this with Stephanie Pomboy. Guys, can you go to the corporate margin chart where we show, where you're coming from in rate of change terms or in macro on slide 58? Always matters more than any other thing. Bubbles are perpetuated by revenue growth accelerating. Revenue growth in this case was accelerating because of AI in particular in the back half of last year. So that chart on the left just shows you U.S. corporate profit margins have never been higher, and this is in a pre-tariff world. Okay, tariffs of course take down your margins. So now we're coming off the mother of all peaks in corporate profit margins.
Yes.
I mean, when you look at you own a lot of businesses. Actually, what I love about you, amongst many, many things, just you as a person, is how you have an ability to connect what's going on in Main Street, whether it's through the lens of everything you do, the companies that you have stakes in, the things that you're observing, and Wall Street. A lot of people can't make that, can't connect, as Gabelli would say, connect the dots, So can you talk about that? Like, what would alleviate on that chart? What would stop that from going down? I mean, or what would make it go down even faster than we think? I mean, there are a lot of different ways you can ask the question.
I'm looking at the chart right now, and I just realized I don't have my wand with me because it is going to be a magician that's going to fix that.
Right.
Not reality. This cannot be fixed. We are there. We've already been there. So I saw it in my data, my businesses, a recession 18 months ago.
Yep.
In the fall of 23. Remember I called you and I said, dude, all of my tenants are 30 days late. Not all, but a third were 30 days late on payment. And so I saw it, and we saw one of your last guys, Stephanie, she was talking about how the government ramped in debt, the government ramped in employment, all these things to jam it right to the election. And this is why I was so bearish coming into this year, because the comps off of that are absolutely impossible, not going to happen. And we're there. Independent of that, we now have this tariff disaster. But I'll give you an example of a business of mine that I realized on a call on Friday. I'm a part owner in a wine distribution business. A very good friend of mine, and you know who you are, hello. And she's sweet as could be, runs this very successful business where she finds vintages in Europe at about $12 a bottle and imports them over here, rebrands them, relabels them, it meets all of our criteria, and it changes every year. So she's like a wine sleuth, finding the right thing that's really good, re-importing it over here, selling it at 25. Our profit is $3 a bottle. So it's a terrible business. And when I say terrible, crap ton of working capital, low margin business. Fortunately, we don't have any debt. You got to do volume. That's the game. And under what we're looking at right now, we might be looking at a COGS that's going to be swell after tariffs are done. I'm assuming it goes right. I'm assuming that it's going to all go the right way with Europe. And I'll say it right now, we will, for Europe, not China. But I don't know that we can run at a profit. And we're going to have to come up with more working capital. That's the problem. We got to come up with 15% more working capital to get it done. Now imagine this: you're Mr. Schwartz at PNC Bank, and your phone rings, and it doesn't fucking stop ringing because every company that imports anything now needs 15% more working capital today at the same time. How's that go? Because you can't get through to him now. He's busy. He's on calls, and that's it. And that's what's happening right now. That's
probably why my regional bank short, like some people were telling me I was going to get my face ripped off because I didn't understand that Pump 2.0 was going to equate to David Solomon's capital market business taking off and this resurgence in regional banks due to deregulation. There was a real breakout in these things coming in and out of the election. Now when I look at the KRE that I'm short, or the KCE, which is the capital markets ETF, which has Goldman in it, I hope, is all I see there is credit risk. I mean, those charts look like credit risk.
And we haven't had credit events yet, but I think, and I should be very blunt on how I think this plays out, because that's the $1 million question in my case, or everyone's case, $1 trillion question, is that I think that everyone but China is going to get a reprieve of some sort for a period of time starting tomorrow. Mm-hmm. That's what I think, and that's how I'm set up. I am short U.S. vol.
Reprieve off the, okay, here's the shock and awe, here's what we could do to you, Vietnam.
Yeah.
Here's what we could do to you, whatever, and we're going to do a little less.
Everyone is going to get a 60-day window to come down to Mar-a-Lago and rent a suite. No discounts. All right? And we're going to have a hubbub. China's not invited.
Do you know this? Are you like? I'm assuming you know the story. Like when Trump initially got into his first credit problem, he borrowed daddy's money, levered himself up the wazoo, bought Mar-a-Lago in that whole period.
I know that story. That's a good story.
And then he had to get approval to rent, like to basically rent it out and have like whatever buffet dinners and stuff. So he tried to sell the parts of Mar-a-Lago to super famous and rich people. Is that what you're alluding to? Because he is the epicenter.
Yes.
Of credit, like levered credit.
Yes.
Unbelievably, tremendously huge.
Mar-a-Lago is going to be real busy. It's going to be hard to get a table.
So all those rooms exist. They're all going to come down.
Booked. Solid.
We're going to have a chat.
We're going to have tents waiting to get a room.
That's going to take a long time.
Well, I'm just saying.
To negotiate
finger in the air,
one.
60 days. We got a 60-day window to debate in good faith.
Yeah, so you don't mean like tomorrow. Like people right now are on a switch, right? An emotional switch.
Yes.
I mean, we just had one.
Yeah.
Right before we sat down. There's the latest headline. The S&P's at an intraday reversal like it's had many times in bear markets before. Like people, if they hear something's going to happen tomorrow, they mean, what do you know? What do you know? Who told you?
Who told you?
Is it tomorrow?
Well, it's going to be very, very difficult to get information because it's so fluid right now.
So you're not part of the elites?
There are a handful I have on speed dial, and occasionally they butt dial me. So
can you imagine? You get butt dialed by Vivek and he just inadvertently leaks something
But they can't talk about it because it's so fluid. It's so fluid and it's so sensitive.
Yeah.
You just cannot talk about it.
So let's go back. So you think that, and this would be very consistent with Lighthizer book, No Trade is Free. Mm-hmm. They hate the Chinese. They don't trust the Chinese. They're like, look, we almost got it done, and then they knew that we weren't going to get reelected, so then they played the stall game, and they lied to us. They redlined everything that we agreed on. There's an inherent distrust of the Chinese, and we're going to stick it to the Chinese.
China is in mortal danger.
Really?
Yes. And they were in mortal danger before, but they're in mortal danger because Xi, who runs everything, strongman economy, you don't own the property, you don't own your bodies, you don't own your health care, you don't own your assets. This is a, if you will, gulag for the public. And they just don't know it because he made it nice enough so they don't all rise up. And I think that he's probably going to go into it's not so nice anymore. And that is a real big danger. And remember, the Chinese, and this, I'm incredibly bearish on China because there's so many things that I could list, but I'm going to try to put it in terms that are succinct. Number one, over the next 30 years, they will have at least 1/3 of their workforce gone, no matter what, demographics. So on top of that, they have infrastructure and capacity that is for a much larger population, which is only going to shrink. So China will be known in the near term as the smoldering turd formerly known as China. That's my view on how it goes. And Xi doesn't have information. He's surrounded by yes men, and he's a strongman dictatorship. So they don't have law, they don't have journalism. It's a very different world than what Americans are used to processing. This is a slave nation, in my view. Your organs are not yourself. If you're Muslim and you happen to be of a certain belief in a certain region of China, you can be arrested and have your organs harvested by entities that are associated with the government. This has been going on for years. You know, the organ trade in China. It's crazy. It's crazy that this is not even an issue at the United Nations, right? And it's really because China has been able to pay off everybody, and we saw it in COVID, paying off the WHO, paying off Europe, and I would say even conspiring with Joe Biden in order to suppress the truth that COVID was made from a Wuhan lab. They've been able to pay off everyone. I believe that is beginning to end right now under Trump. Wow, that's a big transition.
Massive.
This is really, so how I'm set up, and for your listeners, you want to know how I'm set up, is I am long US net, so I'll be short US vol. I'm looking for a relief rally potentially, and I am long China vol. And that this is going to go the wrong way for China, at least in the near term.
If you're long vol, for those of you that are new to this, that means that you're short the market and vice versa.
I'm assuming bad things, less bad things US, very bad things China. That's how I'm set up.
Okay, so what about the things in the US that are very bad for China? A lot of businesses, that's very bad for US businesses that need China.
The next leg, which she will do, is very likely boycott American products in China. McDonald's, Starbucks, Tesla, Apple. There's many others. And then they recently passed laws, which kind of cracks me up when they pass a law, because it doesn't even matter. You know, they can do whatever the hell they want. And now they can nationalize the technology of foreign companies in their country. They pass that law. So they're basically literally telling you, this is what we're going to do, That's it. So
what about all the, just Amazon? You used a very basic example of the wine business and how the margins get completely crushed.
Yes.
So my wife's turning 50. So I'm planning part of the birthday party with my daughters. So we're on Amazon, we're looking for all this stuff that's really cheap. For $88, I'm not gonna tell her about this. She's not gonna watch you and I, because she just wouldn't, that's not in her level. She's not interested in us, or in me in particular. But
I got a similar wife.
But for $88, you wouldn't believe the amount of things that I got. And I'm assuming that 90+% of that comes from China.
That's right.
Yeah, so how does that part of American life change?
If the tariffs go through the way they look like they're going to go through tomorrow, and this is going to be a very long slog, it is very bad for Amazon. It is very bad for half of the vendors that sell trinkets on Shopify. It is very bad for sneaker makers. It's very bad for everyone who has Dell, for instance.
So AI is not going to solve for all this? No.
It'll take a while.
Yeah.
And then, of course, we're in the mother of all bubbles, and AI is part of that bubble. I had another call from a tech PM, very bright guy. He runs a mid-sized tech fund. I'd never talked to him before. It was a friend of a friend saying, I got to put my friend on so we can talk, go through it. And he was telling me what his long book is, and he's a very bright guy. And I told him that you realize these are all the hedge fund hotel names. Like, you're in it. You're in this stuff. And you think that you're unique and that you figured this out, but this is where everyone is. This is what they're doing. And then I started talking about what is happening in global trade and so forth, and I realized he didn't really quite grasp this. And it reminded of me in 2007, 2008, when I was a very young PM, and I asked, how old are you? 33. And that is what's happening. We have a lot of very young PMs who are running meaningful money, and they do not know what they're looking at yet.
I could make this up if I tried. I could show you the text. You could read it. Actually, you could read it. What does this say right here? Just read that.
First thing he said, fuck, we really should have listened to Keith when he was in here.
So that's from one of my teammates who just came out of a meeting in Dallas, Texas. Today, Van Skyver's there with Fernando, my energy guy and industrials guys, and they're seeing hedge fund accounts. And the guy that runs the place, same thing. He's at least a decade now. He's probably 15 years younger than you and I. Yeah. And that's his response. And when I present Quad 4 to PMs, it's really interesting. I mean, because I've been doing it for a while. But anytime I present it to a young PM at a very successful hedge fund, could be the Pod Shop, could be this gentleman in particular, they're almost like looking at you like, that's too easy to understand. I would have figured that out already. If that's that bad, I would have can you say it again? I'm like, yeah, just like how you model companies. Yeah. When the revenue's slow and the margins start to compress, the stock goes where? And they look at you like, are you like, is this meeting gonna end? Like, don't treat me like an asshole. And it's like, no, we're doing the same thing with the economy. Mm-hmm. And when it goes down really fast, all your stocks go down. And it's just like, it's an amazing thing to watch. I would say a significant percentage of the hedge fund business does not operate with the quads at their principal orientation is where is the economy going through the lens of the quads. That is still that's not consensus. It's Hedgeye Nation consensus. It's you and I obviously act on that all the time, but I'll meet many portfolio managers who are like, wow, I should have listened.
4 years ago, when we sat here, when I first came on for COVID, because remember when I called you and I was like, Keith, I have to come on your show. People have to understand this COVID thing. It's going to be a disaster. And at the time, I was very, very ill with a autoimmune disease that I've beat, by the way.
My man.
Beating that shit.
Love that. Gone through hell and
my
back.
Biggest fear outside of COVID, because I knew we'd get through this, or I'd hoped we'd get through this, my biggest fear was that the government would start spending money and won't stop. And that's exactly what happened, and that they couldn't stop. And last year, I could see it, and I'm sure you saw it too. The reason why Janet Yellen moved everything on the short end of the yield curve is because we began to lose control of the long end. And that is doom, because that's 1970s. You lose control of the long end of the yield curve. And I'm getting back to your decision process on these young people. And there's nothing wrong with young people, we need them. It was gonna go two ways, where the whole mercantilist monetary system must change and government cuts, or we will lose control of the long end of the yield curve, and that will force our hand to do it. Either we're going to do it preemptively, like what's happening now, and I'd even argue, is it preemptive? Because Scott Bessent is an extremely bright guy, and he is the right guy in this place right now, because he really understands how things move and why. And he knows that we have a problem on the long end of the yield curve, and it has to be fixed. And when you start drawing out how it has to be fixed, this realigning trade is one of the ways to do it. And right now we have the might to be able to force that trade. That's what's happening right now. There's going to be incredible winners and losers. And to get back to your point on this young fellow who doesn't understand it, they have been conditioned for 15 years that the put that comes to fix everything is magical. Mm-hmm. They don't know how it happens, they just know it does happen. And it's very important to understand how it happens, because now the how matters. Mm-hmm. And they can't do it because we can't put debt on the long end of the yield curve.
Well, this is, like, guys, go to slide, this is going into the back 40 on this presentation I recently did, but slide 164, guys, if you take, so what we like to take are their own words, because I agree. I mean, Scott Bessent is not only an intelligence to me doesn't matter. It's more so credibility in this case. Like, they're telling you exactly what you need to hear. I mean, we're using Mr. T, my prediction pain. Like, you don't even have to read between the lines at this point on what the administration's saying about what quad we're in economically, which is quad 4. Yes, they'll blame Biden, et cetera, et cetera. But the silver lining, Mike, is over there on the right, where, to your point, I mean, we're hitting there's $4.5 trillion in maturities in the second quarter. So what Bessent needs to do is roll and term that out. with lower interest rates, and he just got them. Like he just got the 10-year yield just went down by what 80 basis points. The 2-year yield is down like a lot from where the cycle peaked. Are you saying that he's not going to get the weak economy that has perpetuated the down bond yields, that it can help him term out in this very critical window between now and the end of June?
I would make the guess that he is going to also refi this stuff out on the yield curve.
Okay.
Because they need time.
Yeah.
They need time for this to work.
But just back to because Gunlack was troubadouring around on CNBC as he would, because he's just pushing his own book. I mean, but he completely missed this move on the long end of the curve. I mean, you nailed the bond market. You nailed that people would be talking about a recession by March. You said this in January.
First week.
But he's out like, well, the reason why bond yields are up yesterday is because of the deficit and the debt and how much debt we need to roll. I mean, bond yields are up for one day.
Well, that was a big sign yesterday. So I was on the phone with some, I would argue, pretty influential people yesterday that have an idea, and they believe that it was China that's selling.
Yeah, there's
and
that.
The fact that you
Mike
could
Green
see
that, yeah.
China selling, and I talk to Mike Green like every single day. It's like I'm like, buy Mike Green's wife, because it's 2 a.m. It's very hard to come in and move that bond market like that in a down tape. And you saw yesterday, there was a huge seller with duration.
Yep.
I mean, you only do that if you were cashing up for a nasty storm. Mm-hmm. And that's when I called Mike immediately. And I was like, there's going to be no deal with China. They are winterizing everything.
Yeah,
and they have been doing so for years.
They did that, and then they devalued the yuan overnight.
Yes,
and then,
just the beginning. Just the beginning, by the way.
So it's not like they didn't know. That like Pump and everybody else, anybody that they thought that they could talk to, they've talked to, and they're like, "Fuck, we're screwed."
Game of chicken.
Right.
Game of chicken.
Yeah.
He thinks that he can control his populace and whatever he thinks is going on there, versus the political fallout that is going to be on Trump's plate.
Now, do you think, like, guys, go to the next slide, the pain versus reward. We've talked a lot about the pain. You've nailed the pain. But you also said that you expect things to get less bad. Do you agree with this? Phase 1, early 2025.
Yes.
Phase 2, we're in the middle of it right now. And phase 3, we come out sometime into the fourth quarter and into 2026, seeing a reacceleration. Do you think that that's possible?
No. But I believe that they're going to make great efforts. I believe, and we just talked about it before I went on. I talked to Mike about it on Sunday, Mike Green, and I was like, they can't. If you're going to build U.S. infrastructure in order to become an exporter, it doesn't happen overnight. It all happens over a very long period of time. And I think the bank situation is going to be such that they can't lend for you to build stuff. And so we're very likely, in my view, in the back half of this year, going to have a Marshall Plan, U.S. Marshall Plan, U.S. Government-backed loans.
Really?
That way it's balance sheet neutral. Government-backed loans, and there will be spend on top of that in order to build U.S. infrastructure to become an exporter.
Government, like direct loans or through the regional banks?
Oh, no, they got to get paid. So yes, the regional banks got to make a fee on this stuff because they're going to be hurting. They're going to be hurting. So I think it's going to be resold through the banks and guaranteed, kind of like FHA loans.
Really?
I think that's what's going to happen, because it's not like I have any view on this, and nobody's told me this yet, but I think that there's a possibility that, look, he needs to get this stuff done before the next general election, or at least in motion, and we're going to need jobs and a build. And so I expect fully a multi-trillion-dollar Marshall Plan for the U.S.
Isn't that interesting?
To rebuild the infrastructure, distribution, and the plants to make stuff, whatever the hell it is. Now, I have to comment, though, on our good friend Scott, the stuff that doesn't make sense. He's saying things that don't make any sense now, and that is
they definitely don't make sense to billionaire Wall Street guys.
This is a problem.
The levered
for me.
long community no likey.
Well, Scott's really, really smart, and so when he's saying things that don't make sense, he's doing it because he has to, and that's what worries me, that he's saying things that don't make any sense because he has to. He says we're doing this so that we can have lower interest rates in the future. Okay. Mm-hmm. All of this build, onshoring, is not lower interest rates. It is higher. It is a sharper yield curve. That is wage growth. Wage growth is inflationary, meaningfully. You know, that translates into housing costs, it translates into all these things that are inflationary. And so what I'm thinking is that he's saying, yeah, lower interest rates for this period while we refi XYZ, but on the other end of that, we're very likely gonna have higher interest rates on the long end, if this thing works. And that, so it bothers me when things are being said that make no sense. And you know, the talking heads on CNBC are simply, you know, restating things that are just flat out wrong and impossible. So I get very worried when I start hearing a whole lot of things that are not possible, fantastical. And that is the news of the day. Based upon my talking to many CEOs over the weekend, private companies and public, but mostly privates, because that's what I really wanted to talk about. I think all of them are looking at right now laying off 5% of the workforce. I think we're going to see a meaningful jump in a collapse in consumption. I mean, you want to be short, in my view, American Airlines, Hilton Hotels. You want to be short leisure and travel. And God, I'm so sad saying that because I don't wish ill on anyone. I'm just trying to articulate to our audience here what I'm doing in my book in order to make money so that you can too.
You know, the market, I mean, first of all, you've had this view since January. The market has paid that position.
Yes.
More so when we look at, guys, show the bongo border, what we call the U.S. equity sector style returns. You know, GICS level 1, the top 11 sectors that you could own. If you're betting inside the game as opposed to just on Spy Monkey itself. I mean, the worst place to have had your money is next to tech is in consumer discretionary, right? Now, that is primarily because Amazon and Tesla are the two biggest components, but they are consumer discretionary. So, you know, your broader point, I mean, the carnage in single stocks that are not in the XLY. I mean, I was going through it with McCullough this morning. The amount of graveyards that we're standing on right now that he still thinks go a lot lower. It's incredible.
I don't disagree. And what your investors need to know also is the kinetics of what's happening internally. About 20 to 25% of the flows, daily trading and healthcare and consumer and many spaces is hedge funds.
Yep.
And many of those hedge funds are what you would call the pods. And when you have names randomly moving 10% intraday, you can't have a book on.
Right.
The VAR, value at risk, for those that don't know, goes to the moon. And what we've begun to see is prime broker margin calls to take down VAR. And you can't have a book. And so what we're going to see, and we're going to see it this week, is the liquidation of books as they take down. Shorts up, longs down.
Well, that's, you know, I mean, the last session, you know, Mike Green, Tier 1 Alpha guys, we talked about the 50% plus of daily flows, right? That's systematics. That's not what you're talking about. You're talking about now we got that 25% at least. Yeah. Walk me through. Okay, like first of all, we just saw back to back the two biggest volume days on cash equities that we've ever seen. Ever is a long time, irrespective of how long you and I have done this. There had been some material capitulation that you just said you'd expect to see some reprieve from the capitulation. But are you also saying that we've still not seen the degrossing or the taps on the shoulders and the outright reductions of books, and that there's a tail to that?
We're seeing it now, but it happens so fast. And this is part of what Mike Green talks about and is going to write a best-selling book about.
That's on your list too.
Yes.
That's on his prediction list. I know his prediction list because one of the few that he's predicted that has not come out to fruition yet is Professor Plume 99 puts out a best-selling book.
Yes.
That's Mike Green.
And it will be. And it is a lot about passive investment and how it's creating nobody on the other side. Passive is now like 60%, active is like 40%. So when passive comes in to sell or buy, it has to be buying or selling to the active managers, which is me.
Yeah.
And that active manager group right now has a margin call. They can't expand their books. So if these passive guys are going to come in to sell, you're going to see 6, 7, 8% moves in markets because there's nobody on the other side. And the hedge funds can't respond fast enough because the VAR goes like this. And then your prime broker calls you and says, you can still have 7 times leverage on. You're just going to have to pay 8% interest on the last $1 billion of it. And that's what happened. And so they're coming, so they're saying, take down, take down, take down, take down.
So like when you think about 2008, and we've already made, I mean, the beauty of Wall Street and the beauty of America, I would argue, is creative destruction creates opportunity for a whole new cattle class of people who wouldn't have known otherwise. They're going to be, seeking profit. They're going to do what a lot of people. You don't become a successful 35 to 40-year-old hedge fund manager unless you've done great for the last decade or more. Right?
Many have.
Right. So, do you have thoughts? I know David Einhorn does. I mean, do you have thoughts on what the current kind of like the vintage that's a decade younger than us? Those that have had that experience, like how this ends for them? Is it beginning for them? Is it just part of they can run net neutral and everything's going to be fine? Like, how do you think this goes?
We're in the moment now where it's not fine because so many books are going to be unwound at the same time that it can't be fine. Meaning your good ideas go down more than your bad ideas.
That's exactly what's been happening.
Yeah. And that's doom. So it's a run to get your book off so you can keep your job. So I got a call from Bloomberg. They were asking me, they said, Mike, a lot of these small biotech companies, and for those of you who don't know, I'm a healthcare specialist, if you will, and I run the Pink Fund, which is the ticker. I don't even know if I'm allowed to say that. I guess so. But anyway, I run the Pink Fund, and it is the fees and my compensation goes to the Susan G. Komen Foundation for breast cancer, and it largely invests in healthcare specifically. And so Bloomberg called me up and said, Mike, where's the bottom here? A lot of biotech companies are trading at cash, below cash. And they said, isn't this the time to get in? And I thought about it for a second. I said, no, I'll tell you when the time to get in is. It's when the bodies clear out from the East River. That's the time. And there are 100, and I'm not being bearish on healthcare. They all look like this: industrial, cyclicals, consumer discretionary. There's 120 dedicated books in healthcare that are pod-like, whether it's a healthcare hedge fund or a Millennium Citadel and others that are running specialized books.
Books, can you give people a sense of what the minimum size to maximum size of these books are? Books are what used to be hedge funds standalone are now books inside the motherships.
Yes. On the low end, 500
million.
Yeah, and on the high end, 5 billion, generally. Yeah, that's about it. So we're talking about a lot of money. There's 120 of them. I fully expect by the end of this year, I would like, meaning I'll get bullish if a third of those people are unemployed. You need to hear about really talented people getting let go. That's when the bottom forms, in my experience. That's what happens. So it's not a matter of price, it's a matter of when. And yes, I want to be right on the price and get there, but more importantly than being right, I want to make money. And you make money when the East River clears out of bodies. That's it.
Well, that's going to be, I mean, I've had, because we have a lot of institutional clients, obviously, we're asking that same question. And until they all have to stop selling the same exposure, the bodies haven't actually resurfaced.
They got tough decisions.
I mean,
tough decisions right now.
There have been the redemptions that happened at the end of March did not include what just happened in April. Okay? That was just phase one of the drawdown. Like I always say, drawdowns become, in quad 4, drawdowns become crashes and crashes become educations.
Yes.
If the ultimate education, the most important education I've ever had was getting fired.
Yeah.
Yeah, and now that
Change your life.
That's where do the bodies get taken out on the bear side. I got fired on November 2nd, 2007. The market peaked within a week of that. So education. Like, you need to have you're saying that East River is going to be a new university. It's going to be a new place where people learn how to tread water and get to the shore and start all over again by not doing what they were doing.
When great talent starts getting ejected, that's near the end.
Well, what is talent? What is talent that doesn't evolve?
Well, sometimes it's not a matter of evolution. it's a matter of Six Sigma. You have a sequence of events that are incredibly improbable happening to very, very good people, and they get ejected.
Okay, so some people would say, sorry to interrupt, because I have a lot of thoughts on this. Some people would say, okay, you know, the best, actually one of the best consumer PMs we've ever seen in my generation, Gabe Plotkin at SAC. You know, what happened to him in GameStop, or what happened to his fund, was just, it had nothing to do with his ability to invest. It had everything to do with his inability to get up.
He didn't recognize that we were entering the mother of all bubbles.
Right.
And retail just got $4,000 checks to buy GameStop.
Right. Okay, now take that. That's an education for him. I think he's doing quite fine.
Yes.
And take that and multiply it by many, many. When you say a third of 120, I know what the math is. But I mean, that's just healthcare managers, right?
Yeah, exactly.
So we have, like, was it, when you look at them floating there, you know, when you're watching Brad Pitt in a movie and he talks about gravity, well, it is what we thought it was. It was the gravity that got them. Was it their inability to evolve alongside the machine and see any of this coming?
I'll share with you what I'm telling my guys, because as you know, I have a number of portfolio managers that worked for me that I trained, many of them running money. And many of them have done very well in this downturn. And my right-hand guys, actually all of my guys, I've told them, in the event that if you're down, you're gross down. But if you're up and you got this right, and most of them did, you need to take your book down, like literally today, by 75%. Because if you do it by 50, you will regret it. You will lose so much.
That's so hard for somebody
who's
talented.
Especially when you win. The hardest part is taking your ego and saying, I nailed it. And by the way, to your audience, I took my book down 50% on Friday.
Well, there you go. I mean, look at on today, the S&P at one point was up 4%. Now it's down. Like you don't have a lot of time to make. So this is what I wanted to get to. This is the heart of the matter, which is talent.
Do you know how much this conversation has cost me today? That's what Mike Green and I said, no, webcasting, you got to be at your desk. And I'm like, no, this is too important. It's going to cost me an incredible amount of money to do this because I'm not trading that. And I have a book on.
Agreed.
And you guys now know my book because I just told you what it was.
Real-time alerts, you can go back historically. Having 0 longs, which I went to before this started at 11 o'clock, is a rarity. But again, the question in my mind is, like, we live in an era where intellect is overvalued, talent is overvalued, richness, elitism, it's all way overvalued. I don't need to hear from fucking Bill Ackman. Get out of here.
He's an important component for us to hear.
But I don't need to hear him. I don't need him in my life. I don't need him in my book. I don't need him in the market. It's important to hear that voice because that is part of the problem is what I'm talking about. But what happens when intellectual value and talent becomes the opposite of what you want to be? A street fighter would sell 75% of their book at noon today. That isn't talent. That's a street fighting motherfucker who's going to win, right? That's what I want. I don't want somebody who's just like you're the one who taught me this. People want to be right.
Yes, so very much. And it is so important when you are right to ring the bell. And that is the hardest part, is ringing the bell.
And when you're wrong, to get out.
Yeah, incredibly hard. I mean, that's how jobs are lost. So those jobs, those young PMs that keep wanting to expand their book because the stock is so cheap, that's what happens. And you have to take a step back and realize that the book you're trying to expand is a book of people getting fired.
Yes.
And so you're literally buying their dismissal. And if you're not going to get the very bottom, there's another one behind it to wreck your book. And that's what happens right now.
This is what happened. Like when I joined, and I believe that, you know, God willing, we're all put on this earth at a certain point in time for some reason. Like in this game, it's where you're put into the game. Like I started as a hedge fund analyst in the year 2000, after being on the sell side for a year. I systematically watched every single analyst, including one of my best friends who now works here, get fired between 2001 that were TMT analysts, tech, telecom, media. Every single one of them eventually got fired by '04. Right? Now, that's an important like I believe mastery is born out of experience. Now, mastering your process doesn't mean that you nail it all the time.
You're so right.
It's just when you have not had that experience, and neither have your peers, you're not selling 50 to 75% of your book. They don't do that, Mike.
No, they don't. It's very hard to do. And I learned that the hard way by getting it right and then getting chopped to pieces in the aftermath of all the books unwinding. So no book can survive it. And so what I learned is when you get that drawdown right, you have to take your book down 75%.
Right.
And now, because it's going to turn into a free-for-all. And the issue is, you still might be right. It's just for a week period of time or 2 weeks, you might be so wrong that you won't survive to being right again.
Right.
And that's why,
especially if you have a boss.
That's why you have to take down, because there's so much carnage that occurs in that interim after the deluge.
Yeah.
And I've been there, and that's what I've told all my guys, is that you're going to have to just swallow and take down. Now, at issue, there's many of them that can't do it, and those are the ones that I'm worried about. Meaning that I know a lot of guys that have multi-billion-dollar books on, and they own 3, 4, 5% of the companies that they're in. They can't get out. They're married.
And their employer, if you're at a pod shop, believes in your talent. Therefore, you have to maintain a certain size of the book.
Well, those are the guys that do get out, because they'll force them to get out. But I'm talking about guys that run their own hedge fund.
Oh, you're talking about
Yeah, and it's multi-billion-dollar. They're paid to be invested. They can't just collapse and take the whole book down. And I would actually urge them to do that.
Yeah.
And I have, and it is a debate that happens on the phone every single day.
Well, thank you for answering that question, because I got it. Jonesy asked it to me. It was one of the top questions on the macro show yesterday. It was asked multiple times by subscribers. I got asked by Jonathan Burton at MarketWatch yesterday in an interview. What do you say to people who didn't get out? Like, you just answered the question. Well, you still get out.
Yeah, that's the issue. It's if you're booking gains, you shrink down hard. If you don't, you shrink down hard, because the VAR is going to be so huge.
Yeah.
And I don't know what the news is right now, but I believe that everyone but China is going to get some kind of reprieve.
Yeah.
For a period of time. And I think that China is going to play the game of chicken. And their bet is that they can apply enough political pressure onto Trump that they cave. And look, given these tariffs as of next week, it's like 70% of Chinese businesses that can't function. So, and they don't have the dollars to do a giant stimulus program. And think about it like this, like, if they devalue by 20%, that's 20% inflation. And good luck trying to settle copper and what graphite and whatever it is you're importing in RMB. They don't have a currency that they can settle in. Nobody wants that currency. It's an isolated fake currency.
They don't want the currency. That's why they keep buying gold.
I was explaining to a person who doesn't quite understand this. I say you're a Chinese company and you make widgets, right? You import whatever, raw materials, you make your widget and you sell it on Amazon or whatever, okay? And you're getting dollars. You're getting dollars and you're putting it into your bank account and it's dollars. No, they're not dollars, it's RMB. The Chinese central bank is taking those dollars and you don't really know how many dollars they actually have. So if you need dollars to turn around and settle for your more imported goods, whatever it is, or your raw materials, they're going to run into a gigantic, right now, where they don't have enough dollars.
What about all these companies? I mean, we got to wrap up here, but first of all, do you have Chinese shorts? Second of all, what would, of the majors even, they've been the recipient of not being tariffed, everything from Meituan to, Alibaba.
I think we're on the cusp of the printing press getting revved up, the hell up, outside the U.S. And China is going to drive that. If you look at Pakistan, Sri Lanka, a zillion other countries over the past 5 years, China has massively expanded their surplus trade.
Yep.
Or just colossal, colossal. And you say, wow, that's really great for them, and getting all this money coming into their country, foreign currencies, you know, to help diversify their RMB. Well, the problem is they also financed it. They financed that. So the biggest lender now to these countries is China. And I believe they're going to get that money back, but they're going to get it back from a printing press. That's the problem. I think we're going to have an enormous amount of money printing over the coming years, especially if this trade war persists. And I think that there will be a resolution at some point in some form, but it won't be horrific. It'll be not favorable to China. They run at such small margins. I mean, they export detained gulag labor. That's what they do. And they don't have an easy out on this. There isn't an easy solution. They have to change. I don't believe they can change their economy, especially when the argument would be, and I'm sure others will say, well, we're going to turn China into a consumer nation, right? How do you do that when you're looking at a 30-year population being gone in 30 years? This is what we're looking at. These are the things 4 years ago that I was so worried about, and all of it is literally happening today. All of the problems that started 4 years ago with runaway spending, because I saw we had a fuse left, and we just went, burn the whole fuse. That's it, we're here. That the realigning of the world markets and the way that money flows is happening today. And if you look back at history, there are rare events, like this might only happen once in our lifetime, but it's going to cause a handful of winners and an unbelievable number of losers. So I hate to be grim, but I'm definitely very, very worried about what's going to happen. And the next leg is going to be, in my view, very likely a meaningful credit problem, which we haven't gotten to yet. That'll be the next leg. And that's when we find out naked. We find out who's naked.
Credit problem in the U.S.
Everywhere.
Yeah, everywhere. Yeah.
But certainly in the U.S. And I'm very worried about it because this may take longer. This could very well be kind of like an 08, but 08 was very centralized. 08 was different because it was centralized to, let's say, mortgages for the most part. And very important on that underlying, you had collateral. This time that collateral is not as good as a house. That's what I'm really worried about. The collateral stinks.
Well, back then, I mean, the problem was on bank balance sheets. Now we've transferred it all over to everyone else's.
Yeah, and it's at pension funds, it's at private equity,
Yeah.
It's in people's, the RIA fellow who called me at 7 in the morning to go through his account. That's where it is. I don't think he knows that, but I fear he's going to find out. And everyone else will too when we run into a huge problem on credit. This is why I think we're going to end up having a Marshall Plan in the back half of the year.
That's a thought that I hadn't heard of, as most of your thoughts at particular points that matter can be. So thank you for that, and for just having, first of all, just being back in good shape, good fighting shape. Mike Taylor's, he came back from hell and back again.
Oh, and I have to, your production fellas, they pulled up the slide for me. This is going to be the diarrhea cha-cha-cha market.
Oh, nice.
There it is.
What a way for him to end. What a way to end in style. One time he ended with, he actually started with a roll of toilet paper of issues, and now he ends with that. So thank you very much.
Very full diaper. Straight ahead.
Yeah, that is indeed a visual that we may have to forget after a good day of conversations. But thank you very much to Mike Taylor, to Steph Pomboy, to the Tier 1 Alpha team, and I'll see you at day 2 of the Investing Summit tomorrow.